Yeah, like I think it was the Volkswagen advertising, when they show how smooth the car is, and so they take a chicken and they move the chicken, and as a chicken, I don't know how they do that, but all the chicken have a way of balancing. So they actually, even if the body moves, the head is completely fixed. And so, and then Jaguar made an advertising with a Jaguar eating the chicken. And
Awesome. That's great. I love that. Welcome to another edition of Ringside with Perspective. It's me, Daniel Malan, here in Canada. We got Mikael Lieferink in Cape Town, and we got Clement Wautlen in France. We have another full slab of topics this month, and without further ado, we're going to talk to you about some of the fundamental developments in our portfolio, starting with Philip Morris and British American Tobacco, which we've owned now for quite a number of years. There's been an important new development with litigation settlements in Canada. And Clement, you've taken a good look at this for us. Over to you. What do you think about that?
So just first taking a step back about what is this litigation about. So basically in Canada, about a decade ago, there's thousands of people that sued the big tobacco companies. So it's not exclusive to British American Tobacco or Philip Morris. There's also Japan Tobacco involved in it. And basically they were claiming that they had diseases like lung cancers that are directly related to the consumption of tobacco products. So that's where the litigation come from. Now we are about 10 years after, and the court had appointed a mediator to try to settle this litigation. And what the mediator proposed is that those big tobacco companies, so combined, would pay 32 billion Canadian dollars to the plaintiff. And so if agreed, then the litigation would be settled. So there's quite a material amount of money that is involved here. And we think that there's a few learnings here. So about the attitude of those tobacco companies, like in our case, British American Tobacco and Philip Morris, because they have been quite conservative with how they manage this part of their business in order to do not damage the rest of the group in case they had to pay a material amount of money. If the outcome was negative. So what they did is that they basically kept cash in these subsidiaries in order to settle this litigation in the future. So we thought that this attitude in the way they manage the business was conservative. And also we think that at the level of the litigation, this example also reinforces our view that it should be pretty rare to see a litigation killing and making a company go bankrupt, because it's basically in no one's interest. It's not in the interest of the plaintiff, because we're gonna pay them if the company disappears, and also it's not in the interest of the state, because on one end, if a company dies, then there will have probably job losses, which won't be too good for the reputation of the politician here, and also on the other side, they are busy losing taxes. Current taxes and future taxes that this business would generate. So it's not in the interest of the state either of killing a company through litigation. And the third learning is this litigation in the case of British American Tobacco is also an example of the risk when you acquire a business to get also the litigation, because yes, you acquire the asset, but also the liabilities. In that case, it was a litigation that was already public, but that's also a risk to consider when a company grew by acquisition. And we had this example at 3M. More recently, you had Reckitt Benckiser also. So we think it's also a good learning about this here.
Yeah. Mikael, do you have anything that you might want to add to that?
Nope.
Yeah. I just wanted to top that off and just add that, the thesis that we have around these tobacco companies. I mean, obviously, we're very aware that there's been some irresponsible behavior in the past. But what matters to us is the future. And we know that these companies have been doing a lot to become more responsible corporate citizens and producing new products that do not cause harm to people. Okay, and moving on to the next topic, we're going to talk about Afrimat. There's been a set of results recently which didn't look that good on the face of it, and we want to talk a little bit about the integration of the cement business that they acquired in the last year called Lafarge in South Africa.
Yeah, so Donnie, as you mentioned, it's not a pretty set of interim results on the face of it, but it's for reasons that we can understand, and they do appear temporary in nature. The material detractors in this case was a lower iron ore price, and this is obviously the majority of Afrimat's sales, so it is a meaningful detractor in these results. We've experienced a stronger rand, and with Afrimat being a large exporter of a hard currency denominated commodity, it obviously means that they receive less rands in country. And then they've continued to experience limitations in their export rail line. So again, the issues that they've experienced, they and other iron ore exporters have experienced with Transnet. This has again stifled them. Then they had shutdowns at 2 plants of a major local customer, which was ArcelorMittal, and this has led to an inventory buildup on their balance sheet, which is obviously not great for cash in the short run. And then largely, as you mentioned now, so they acquired Lafarge. They had to take on some debt to fund this acquisition, and they've also incurred some losses in this turnaround of this business. On the positive side, though, so the construction and industrial materials businesses have performed very well. The Nkumati anthracite mine has gone through its J-curve and is now profitable. And it also looks like they are making good progress with their phosphates segment. So it appears Transnet is also finally coming to the party and improve things there, albeit at a glacial pace. So in the short term, it's not going to make a difference, but in the long run, if they do improve anything, it will be a material positive contributor. And so if you break out kind of the 4 mature operations, barring iron ore in this one instance or in this period, they've performed very well. And then you compare it to their new growth initiatives and also to the acquisition of Lafarge. Once those start firing, it's going to be a very material contributor to Afrimat's fundamentals. And then I just wanted to touch specifically on Lafarge and that turnaround. So they've had to spend extra to play catch up on maintenance capex and also to restructure the business model and the employee base, and then increasing efficiencies and upping the capacity utilization. So that's kind of where those additional expenses went to. But as we've evidenced in the past with other transactions that they've done, they've got an exceptionally good track record in turning businesses around. And not only to make them more profitable, but to also position them as the lowest cost producer in that segment. And if we look at the multiple that they paid for this business, they paid bargain prices for it. And that's even if you add the additional expenses that they now have to spend to restructure this business into that base. And then they did this at the bottom of the cement cycle, which is really smart. And so if we see, should Lafarge kind of produce numbers in line with the median industry numbers, historic industry numbers, it's going to be a proper contributor to their fundamentals. And so just packaging it all together and looking at the whole thing, our thesis for Afrimat really hasn't changed despite a weak 6 months of results. There's still very strong executives and operators with material skin in the game. They've shown a very good track record in both their M&A strategy, their turnaround strategy, and in their listed game. And they are the lowest cost producer. And they've got a very strong entrenched culture. They're very cost conscious, focusing on a strong balance sheet and cash flow generation. And we can clearly evidence their strategy, and they communicate this in a very honest and straightforward way, which we appreciate.
Clement, do you have anything to add to that?
I would just add, with regards to the Lafarge business integration, I was quite impressed seeing in their latest presentation that they have a slide where they explain how they integrated the team and how they try to embed in those people the Afrimat culture. So I was quite impressed by this because it's something I've basically never seen in the past. So yeah.
Yeah. I saw that as well. I think it was quite detailed. I mean, they gave the numbers on how many meetings they had on site to train people in the culture and as they call it, the Afrimat way. I thought that was quite impressive. Okay, thank you. All right, we're going to talk about next about the share buybacks. We've actually have quite a number of our companies that have announced quite significant share buybacks or busy with it. Companies like Boston Beer, Ruby, Afrimat, Adcock Ingram, Remgrow has been busy with a big share buyback of over R1 billion. Clement, I want to hand it to you. Some thoughts that you have around share buybacks across our portfolio at the moment.
We like seeing this because it's really rare to see companies with a good listed game. So when we see developments on that side, in our portfolio, it's always pleasing to see. And in that case, so we had so the 4 companies you mentioned that 5 companies you mentioned that did some buybacks, and we for 2 of them at least there's very material buyback ongoing. So in the case of Boston Beer, they could buy back 5% of their shares outstanding, and now they announced they will increase it to up to 20%, and they have already executed the 5% part. And we think that possibly this increase of the share buyback could be also a way for the founder to increase its stake in the company. In the case the company could be acquired, because that was also a part of a thesis that the company could be a target for acquisition. So maybe there's something to read inside this on that side. And also Afrimat, because Afrimat in the past they didn't buy back materially shares. So when we see that they ask for potentially acquire for the authorization to buy back up to 20% of their shares, we think that's also a material positive side, especially considering that we highly rate the capital allocation quality of the management team.
Mick, do you want to add anything to that?
Yeah, so again, 2 things. First of all, just kind of highlighting how rare it is to find people that understand the value of acting counter-cyclically and buying back their own shares when they are at depressed levels. Often cases it's ignored or paid very little attention to, but it is actually a very good way to create incremental value to the remaining shareholders. So once again, it's a smart move. And then secondly, just with regards to Afrimat, so they've been, as we mentioned, they've got a very good M&A strategy, and we've spoken to them about this before, but it's in terms of how do you prioritize your deal flow, and it's really the ones that kind of give you the best prospective returns. So you put all of them on the table, and it might just be that just investing in your own shares might give you the best prospective future returns, and there aren't enough other good M&A opportunities on the slab.
I was reminded of a story recently. I think Warren Buffett once said that Charlie Munger he calls him the abominable no man. When Buffett wants to buy something, Charlie just constantly says no until it's a no-brainer, and then they buy. And I think very similarly of Andries van Heerden, who's the CEO of Afrimat. He's the person that says no until it's an absolute no-brainer, and then they go ahead with the deal. And I think there's a lot to be said for that. It's probably something that we can also learn from in terms of our own investment process. The last topic for today is a Spanish company called Mapfre. This produced a good set of results, and they're focusing in on their core business. I'm going to hand this one over to Mikael. What did you see in these results, Mick?
Yeah, Daniel, so, a decent set of results, quarterly results for the group with good premium growth across the business. But to perhaps give our listeners a bit more context of what we look for in an insurance company, here's a couple of attributes. So we look for scale, in the business, and then diversity in its product lines and also in its geographies. And this is something Mapfre definitely has. We look for trustworthy owners and leaders, and again, it's something that we feel that we can evidence in Mapfre's case. And then something a little bit more jargony, which is a combined ratio of less than 1. And what this means in simple terms is that their business and insurance expenses and the claims that they have to pay out is less than the premiums that they collect and the investment returns that they make on these pooled premiums. It demonstrates a very good underwriting discipline, or that they price their risk appropriately. And in Mapfre's case, they've got combined ratios of 96% and 82% on their non-life and their life segment. So very healthy. Another one that we look for is the solvency ratio, well in excess of 100%. Again, in simple terms, it just means that they've got enough liquid assets on their balance sheet to cover obligations towards policyholders, their creditors, and other beneficiaries. And in Mapfre's case, they've got a solvency ratio of 208%. So again, very healthy. And what I found interesting was that one of their core values is to guarantee solvency. It's the first time I've seen that in any insurer's core value system. And then we also, obviously, as in other businesses, we look for the conservative use of debt. Again, in their case, they've only got a leverage ratio of something like 26%. So again, it shows a conservative attitude on their part. And then perhaps the final one is just the matching of the timing and the quantum of the investment assets that they hold with the payouts and the cash flows going out to meet their obligations. And again, this is something that Mapfre has managed to do. However, they have fallen short in their auto insurance business, and this has happened since COVID. And it's their second largest segment in the non-life insurance portion. So it is material. But if you look at what's happened in the broader industry, it's not an anomaly. It's in line with that. In fact, they're sitting at a 24-year 24-year peak in loss ratios across the industry. And it's for reasons that we can understand. And again, it just goes back to a very high inflation scenario where their expenses on the insurance side has gone up faster than they've been able to push up their premiums. And then on the demand side, because the interest rate cycle is at a high point, the demand for new automobiles is lower. And if either one of these or both of them improve in combination with higher premiums, then it will obviously be good for the business. And there's already evidence of this improving. But for the rest of the business and their segments, they appear to be doing very well, especially in their reinvestment segment, or the reinsurance segment, sorry, not the reinvestment segment, and in Brazil, which they're shooting the lights out.
Yeah. Clement, do you want to add anything to that?
Yes, just with regards to what is also pleasing to see that those results. So we met the management team a year ago, and what they guided to us perfectly match the results they have now. So there's really consistency in between what has been said to us and what happened in the business. And with regards to the performance of their auto business, we can clearly understand that there's a lag in between. Yes, they are busy actually doing the right thing on the renegotiation side with the business, and when the actual improvement on the margin side happens. So we are busy seeing this lag now decreasing and the performance of this business improving. And just to add also with regards to the history of this business, it's also a classic example of companies that were excellent companies in their space, but they have happened to a point where they matured. They were seeking a lot of new room to grow. They started expanding the business through acquisition that happened to have performed poorly because it was not in geographies where they had experience in, or in businesses they had also experience in. And now the business has gone the other way around. They had sold out those underperforming businesses, and now they can refocus on growing from an LC base their core business. So we see that also as a big positive, because we have also evidences that they've learned from those experiences. And there's this material unseen with the asset management business that they never talk about, but that they are busy organizing properly, and they have appointed new leadership here that has a clear strategic vision. So there's growth optionality also in that part of the business.
Something I recently found out, what I like about the company, is that it's ironically, it's owned by a foundation in Spain, and that owns 70% of Mapfre. And when you look at the purpose and the vision of the foundation, it's essentially to do good in the world. And so they're using the Mapfre business model as a sustainable producer of cash flow for the various activities that the foundation is pursuing around the world. And I think that's a really unusual thing to find in the listed markets, and which makes this and helps to perhaps understand when Mikhail talks about the conservativeness of the business. It actually helps us to understand where that is coming from, which is quite interesting. Okay, so that's a wrap for Ringside for this month. Thank you very much for your attention and your support of our business. We really appreciate it. We're excited about the year end coming ahead, and taking a bit of a break for a change. And we hope you've had a fantastic year. And as we always say, our work continues. Thank you.